Hello traders, Gary Wagner here. Just about 2:30 in Honolulu, 7:30 in New York. It is Thursday, 17th day of December 2020, and this is the daily report for gold and silver. Phenomenal strong upside moves in both the precious metals and U.S. equities, with a dramatic decline in the U.S. dollar is the best way to characterize today's activity in the financial markets. With the dollar under pressure, it is still a safe haven play to move into gold and silver, even though the stock market is running concurrently not only hot, but to new record highs. Simply put, this is due to the fact that the dollar is devaluing each and every day. So your bulk of your capital needs to be in a safe haven asset or in equities, but primarily not in savings or in the US dollar. On today's show, I want to talk about a specific strategy of scaling or adding to our current long positions. We'll begin that topic today, but first to the price board. Traders, truly a monumental move in both gold and silver. In fact, really across the board in the precious metals. We are looking at the February contract of gold. It gained $31.70 today and is currently fixed at $1,890.80. Spot gold also had a strong gain today. Disregard the change that you're looking at, but that is currently at $1,885.10. And of course, the shining star between gold and silver today have to be attributed to silver, which gained almost 5% in trading, 4.8 to be exact, and is currently bid at 26.25 cents. The other two things that we are currently trading and involved in are two ETFs. First to GLD, that gained over a full percentage today, $1.84 per share, and is currently bid at $176.74. And then SLV gained 2.24% and is currently bid at $24.15. Now, a lot of the changes today were attributable to dollar weakness. As you can see, down approximately 0.8%, 0.78% at 89.65.5. We have also stated that we see no technical support until it hits 88, so that's still a ways away from current market pricing. The industrials were also strong today, but only lukewarm in terms of percentage gains. The composite gains 0.8%. And the 100-plus point gain today took the NASDAQ composite to a new all-time record high. Lastly is the Standard & Poor's Index. And as you can see, that gained 21 points. It is at 3722, and it is right at an all-time record high. Lastly, I do want to have a look at Bitcoin because it has been on an absolute tear recently, now trading almost at 23,000 per coin, 22,915, after today's daily gain of 9.48%. When we look at our daily chart, which I've just kind of enlarged on the bottom right hand of the screen, you can see that over the last two trading days, we have seen it move from just under 20,000 to close to 23, with a high being just a couple of ticks away from $24,000 per coin. Let's take a look at our technical studies and talk about our strategy for our current trade. Traders, it is hard to imagine, but since Tuesday of this week, we saw gold move from $18.23 to its current pricing at $18.8920, which is just shy of a high that came in at $1,891.20. The key to today's action is another former resistance point should now become support. And I'm talking about the 50-day moving average, because as you recall from this charts, as it has emerged throughout the week, Originally, we had listed 4 resistance areas. The top one occurring at 1941. That, of course, is based on the 23.6% Fibonacci retracement. We had our next one sitting at around 1915, which is now moved to 1912 because it is a moving average and, of course, will change with daily price. The other 2 that we have now listed as new levels of support, the most important being 1847, that was the 38.2 Fibonacci retracement level, and the 50-day moving average, which gold effectively closed solidly above today. So, our strategy. First, we will look to move our stops up before Friday, because my sense is if the government takes the weekend to finalize the wording of this new proposal, they'll then put it to a vote next week. If by some slim chance they hit stalemate again, that would adversely affect gold, and I think the likelihood of that is very low because they have written this new proposal in such a way that it is palatable to both the Republican and Democratic individuals within the House and Senate. Now, where are we expecting the market to go is going to be our next question. And there's a couple of answers to that, whether we're looking at long-term or short-term. And first, we'll cover short-term. I do expect if we don't get any major pullback to see the market come and challenge the 100-day moving average. That is the next logical place for prices to tackle. That is right here, and it comes in at around 1912. I absolutely believe that that is achievable prior to the end of the year. On a longer term basis, I believe we should easily challenge and take out 1941 in lieu of these tops that came in here when the market challenged, call it 1970 per ounce, and that was really in the second week of November. So to that end, I want to talk about a question that was asked to me by one of our subscribers. This subscriber resides in Guatemala and is involved in the jewelry business and has been involved in trading gold, I believe now for the 3rd generation. And he asked me about adding silver to his position as well as scaling his current position. And there's a couple of rules you want to follow. First of all, if we see solid follow through tomorrow and you have gold but was considering adding silver, it might not be a bad decision. Secondly, you want to consider scaling the current positions that you have in gold. The trick to scaling is to create an inverse pyramid. In essence, you have the largest number of positions at the initial entry price, which will become, of course, your most effective positions because they will be at the lowest price if the market continues to move up. If, let's say, you bought 6 contracts of gold, the next scale would be to add 4 contracts in addition to that. Following that, if it's still moving in our direction, you would add 2, and then you would add the final 1 contract to top off that pyramid. At that point, if we're in an out-and-out rally, you could continue to scale, but it would be at 1 contract at a time. This way, if and when the market does decline, and trees don't grow to the sky, Volcker put it quite eloquently, then you have the least exposure or the least number of contracts at the highest price that you paid, and therefore, as you trail your stop up and get knocked out, you will have the bulk of profits coming in from your base position that you entered. The next logical question to ask is, at what price points would I look to add additional positions? And that's a fairly easy thing to answer. We got in between 1860 and 1866. As this market moved higher, we crossed certain milestones. And the first milestone really occurred today when gold prices traded and closed above its 50-day moving average. That would be a logical point to scale in additional contracts. So above that, you would look at your next price point as this 100-day moving average. That is currently at 1912. So if we get an effective break and close above that, you could scale there. You could also, or should scale, additional contracts if it continues to trade higher and trades and closes above 1941. In other words, you scale at price points that are logical resistance levels that then convert to support as the market challenges and closes above them. And obviously, this technique of scaling and adding to current positions should be looked at if you have a silver position, a position in GLD or SLV. And next week, I'll begin to cover the particular price points that we're looking at in silver and those two ETFs. For today, my recommendation is to maintain your long positions across the board. And most importantly, if you are looking to scale, look at the price points that we talked about in gold, and we'll cover silver, as I said, Monday and throughout next week. As a third-generation gold trader and someone who has been involved in trading commodities and equities for the last 35 years, there have only been a few moments in time when I felt that there was a special environment that would lead to tremendous upside moves in various vehicles. Specifically, now I'm talking about gold and silver. I believe that due to the expenditures already presented by the U.S. Treasury and the current stance of the Federal Reserve, gold prices could go dramatically higher through 2021. And we certainly want to be involved in it, as we are. This has been Gary Wagner wishing you, as always, good trading, and we'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.